Welcome to Kharutai channel. In this video, we are going to see the methods of depreciation. Then two methods we are going to discuss in detail, that is fixed installment method, which is also called a straight line method or original cost method. The other one is diminishing balance method, which is also called as reducing balance method or written down value method. And at the end, we are going to see the difference between these two methods, that is straight line method and written down value method. Methods of depreciation. There are different methods of charging depreciation according to the nature of asset, use of asset and necessity. Its nature, use and what is the need of that asset. As per that, we have many ways of calculating depreciation. Following are the different methods like fixed installment method, which is also called a straight line method or original cost method. Second is diminishing balance method, which is also called as reducing balance method or written down value method. Then is annuity method, depreciation fund method, revaluation method, insurance policy method, and machine hour rate method. There are other methods also, but in 11 standard, we are going to see fixed installment method and written down value method in details. Fixed installment or straight line or original cost method. Under this method, depreciation is charged at a specific percentage on original cost of the asset every year, so as to reduce the asset account to nil or scrap value at the end of the estimated life of the asset. How is the calculation done? If the original cost is 1 lakh and depreciation is 10%, then in first year depreciation will be 10,000. And after deducting that, the value at the end of the year will be 90,000, which is written down value, WDV in short. And similarly, in second year also 10% depreciation will be charged again on original cost. So again in second year the depreciation will be 10,000 and this will continue every year. The depreciation amount will be same, and from 90,000 minus 10,000, 80,000, 80,000 minus 10,000, 70,000. This way the value will get reduced to nil or scrap value, if any. So how are we going to calculate this annual charge, that is depreciation? Under this method, what is to be done? All that is necessary is to divide the original value of the asset minus its residual value, if any, by the number of years of its estimated life. For calculating depreciation, we will take the original value, we will reduce any scrap value, that is residual value, if any, and we will divide this amount with the estimated life, which is in years. So what is the depreciation formula? Depreciation per annum is equal to original cost minus scrap value. Now this scrap value is not mandatorily given. If this is absent, you can ignore. And this amount, original cost minus scrap value, be divided by the estimated life of the asset, which is in years. And how to calculate original cost? We have seen this: purchasing price, any cost of purchase, acquisition cost, plus any other incidental charges, installation charges that we have to include. Let's take up an example. If there is a machine costing rupees 15,000, this is our acquisition cost, purchase price. We have installed it for 3,000. And estimated life of the asset is 10 years, and scrap value is estimated, this is always an estimate, a guess, to be at 2,000 at the end of its life. So how we will calculate the depreciation? Depreciation is cost of asset minus scrap value divided by useful life of asset. What is cost of asset here? The purchase price and installation price. Then 15,000 plus 3,000 will be 18,000. This is our cost of asset, and we have scrap value, so we'll reduce it from cost of asset. So 18,000 minus 2,000 will be 16,000, and we'll divide this with useful life of an asset, which is 10 years, divide by 10. Then we'll get the amount 1,600. This is per annum, and this amount will stay constant every year. Depreciation amount will be same every year in this method. Depreciation is also charged when the rate of depreciation is given. It is calculated by using the formula depreciation per annum is equal to cost of asset into rate of depreciation divided by 100. So when rate of depreciation is given, we don't need that information of scrap value and estimated useful life of the asset. That information is not required in this case. We just have to apply percentage on the cost of asset, and then we will get the depreciation. If we have to see the example, in the previous example, cost of acquisition was 18,000, and if the depreciation rate is given at the rate 10%, then we will calculate depreciation is equal to 18,000 into 10 divided by 100, that is 1800 per annum. Again, if you are calculating this on Calc, you can just multiply it by 10 and percentage, you will get that amount. Now this example is when you have used the asset for full year. Now what will happen if you have used the asset for part of the year? At the time of calculation of depreciation, the period for which the asset is used in the business during the current accounting year should be considered. Let's see the example. Period used in the accounting year is 3 months. In my example, I am considering we have used only for 3 months, and depreciation is again same 10%. So first part of calculation is same, 18,000 into 10 divided by 100 is same. Just we have to multiply it again by 3 divided by 12. 3 we have used for 3 months, and 12, the year is of 12 months. So we are charging proportionate depreciation. We have used machine for 1/4 year, so 1/4 of 1800 is 450. Let's see another example. Original cost of asset is 80,000, depreciation is 10% per annum, and we have to calculate depreciation as per fixed installment method, that is straight line method or original cost method. So in this, original cost is 80,000 and first year depreciation will be 80,000 on this amount, 80,000 into 10 divided by 100. Amount is 8,000. So the balance amount will be 72,000. On second year, same amount, same calculation, again on same original cost, 10%. So the amount remains the same. After deducting this, the next WDV will be, WDV means return down value, will be 64,000. Again in third year, same calculation, 80,000 into 10%, that is 8,000, and again same in fourth year. So what we can see is the amount remains the same every year. That is, we calculate depreciation on original cost every year. In this method, depreciation is charged every year on original cost of the asset. The amount of depreciation to be charged per year on the asset is constant. The way we have seen in the last example, every year the amount remains the same. So every year the amount is constant. If the amount of depreciation is plotted annually on a graph paper and the points are joined together, then the graph will reveal a parallel line to x-axis. So for first year it is 8,000, second year it is 8,000, third year it is 8,000. If we plot like this, then we get this one line, right, which is parallel to this x-axis. That's why this method is called a straight line method. We get a line. Diminishing balance method or reducing balance method or written down value method. Under this method, depreciation is calculated at a certain percentage each year on the balance of the asset which is brought forward from the previous year. In this method, what we are doing, first year is same. We calculate depreciation on original cost, 10% on 1,10,000. Then the written down value will be 90,000. This is closing balance of last year, and for second year, this is opening balance. So in second year, if you want to calculate depreciation, we'll calculate 10% on 9,000 amount. So 90,000 into 10% is 9,000. So we are calculating depreciation on written down value, that is closing balance of last year and opening balance of this year. In other words, under this method, Depreciation is calculated at a specific percentage on the value of that asset which stands in the books of accounts on the opening date of each year. So this is opening balance of each year. So this year we are going to charge on 10% on this. In third year we'll charge depreciation on this amount. Opening balance. The amount of depreciation charged per year is not fixed, but it goes on decreasing gradually as the opening balance of the asset will decrease in each year. As we see that we are calculating depreciation on written down value every year. First year on original cost and then thereafter on WDV, which is decreasing every year. So our depreciation amount also will keep on decreasing every year. So we can also see that in initial periods depreciation is higher and later on it goes on reducing. So in initial period depreciation is higher and later on it is lower. Now let's take the example. Original cost of asset is 80,000, depreciation is 10%, and now we have to calculate depreciation as per written down value method. Original cost is same 80,000. In first year the calculation will be same 80,000 into 10 divided by 100. Depreciation will be 8,000 and WDV, that is written down value, will be 72,000. This is closing balance for first year and opening balance of next year. So in next year we'll calculate depreciation on this amount 72,000. 72,000 into 10 divided by 100. 72,000. Then on this written down value next year we'll calculate depreciation. On this written down value next year we'll calculate depreciation. That's how it goes on, right? So we can see that the depreciation amount we are calculating on WDV of the asset, that is opening balance of the asset, and we can also see that the amount of depreciation charged during each year of the asset life goes on decreasing every year. We can see that first year it was 8,000, then 7,200, then 6,480, then 5,832. If we plot this on, if the charge of depreciation is plotted annually on a graph paper and points joined together, then the graph will reveal as follows. We can see that the points are slanting and that will give a slanted line. After seeing what is SLM and WDV method, let's see the differences between these two methods. In SLM method, meaning in SLM method depreciation per annum is fixed, is constant, is same, and in WDV method the depreciation per annum is reducing, it is decreasing every year. Next point is, in SLM method depreciation is charged on original cost of asset, and in WDV method depreciation is charged on reduced balance of asset, that is WDV of asset, which is opening balance of the asset, right? Next point is the depreciation amount. This is same as meaning point. The depreciation amount remains the same each year, and in WDV the depreciation amount goes on decreasing, goes on reducing each year. Then value of fixed asset. In SLM method, after deducting depreciation, the value of fixed asset can be reduced to 0. That is not the case in written down value. It can never get reduced to 0. Next point is profits. As the depreciation amount is same, you can see the profits are more in earlier years than later years. In case of WDV, as the depreciation amount is decreasing, you can see less profit, as in earlier years depreciation is high, profits are low compared to the later years. And a connected point, what is suitability? SLM is suitable when the asset is having less repairs and the chances of getting it outdated, obsolete is not frequent. And WDV is suitable for assets where repair charges will be more in later years and the chances of asset getting obsolete is there. Next point is recognition by tax law. They've used tax/law. So in case of tax law as such, SLM method is not used and WDV method is used. So this point is correct for tax law. But if you are talking about other laws, like in company law, SLM method is used. So it is not that this method is completely not considered in any law. No, this is just not recognized in tax laws. Which method? SLM method. Otherwise, both the methods are important in company law. In fact, some intangible assets are required to be depreciated as per straight line method. Then is depreciation curve. This we have seen earlier. Depreciation amount is plotted on graph. In straight line method, we get a straight line which is parallel to x-axis. And in WDV, the depreciation amount is decreasing. So we get a curve which starts from left side and is sloping downwards to right. Curve slopes downwards from left to right. To summarize this video, SLM, it is also called as straight line method, fixed installment method, original cost method. In example, we have seen depreciation is calculated on original cost every year. So in first year on 1 lakh, second year also on 1 lakh. Because of that, we call it as original cost method. Depreciation amount remains constant every year, so we call it as fixed installment method. If we plot the depreciation on graph every year, then we get a straight line, and so it is called as straight line method. Depreciation formula: cost of asset minus scrap value if any, divided by useful life of asset in years. Cost of asset, we include purchase price and other incidental charges in it. If these details are not given, just a rate is given, then we can calculate depreciation using this formula: cost of asset into rate divided by 100. And if the asset is not used for whole year but a part of year, then we can calculate proportionate depreciation. For example, if we have used asset for 3 months, then 3 divided by 12. For 6 months, then 6 divided by 12. That's how we calculate the depreciation. WDV, called as written down value method, also diminishing balance method, reducing balance method. In this method, in first year we calculate depreciation on original cost, later on we calculate on WDV. We can see that the amount of depreciation goes on decreasing. We observe that in initial period the depreciation is higher than the later period. If we plot these depreciation amounts on the graph, we can see a slanted line that shows depreciation is diminishing, is reducing. That's why we call this method as reducing balance method or diminishing balance method. And as we calculate depreciation on WDV, it is also called as written down value method. So to summarize the differences, meaning in SLM depreciation is fixed, in WDV depreciation per annum is reducing. In case of SLM, it is charged on original cost of asset. In WDV, it is charged on reduced balance of asset. The amount of depreciation in SLM method remains same every year, while in WDV method, it goes on decreasing each year. Value of fixed asset can be reduced to 0 in straight line method, but it can never be reduced to 0 in WDV method. Profits in straight line method, it is more in earlier years as compared to later years. Vice versa in WDV, profits are less in earlier years compared to later years. Suitability: straight line method is suitable for assets where repairs are less and obsolescence is not frequent, and WDV is suitable for assets where repair charges are more in later years and obsolescence is more. Recognition by tax law: SLM method is not recognized in tax law, whereas WDV is recognized in tax law. Depreciation curve: in SLM we get a straight line parallel to x-axis. In WDV we get a curve that slopes downward from left to right. So that's all for this video.